Leila, if I could jump off with where we find ourselves, the circumstance and the context. If we start the year 2022, I would describe the beginning of the year as a 4-4 year, that the World Bank was talking about 4% economic growth and 4% inflation. And we have very quickly iterated into a 2-8 year. 2% economic growth, 8% inflation. That is a substantial disruptor versus initial expectations, and it's an even bigger disruptor if you compare this to the circumstance of the last 20 and 30 years, where since the fall of the Berlin Wall, it's become accustomed to anticipate decent economic growth with very low and stable inflation and successively falling interest rates. So this seems to be a step change with the past. The swear word from 2021 was to talk about inflation as transitory, and The Economist says this morning that it's far more permanent than transitory. So if we could use that as a jump-off point, what is your sense of the global context? Is it a case of this too shall pass, or are we really in a different landscape now? And what does that mean for the direction of travel of the South African economy before we come to the JSE?
So, morning everybody, and thank you so much for joining this discussion. It's absolutely wonderful to be able to chat to you. And certainly we are in a very peculiar position insofar as inflation goes. We're sandwiched between the US, which has 8.6% growth. Ours is, of course, 6.5% inflation, 6.5% inflation, and China, who are in a completely different position. Last year, the US inflation was 5.2% and South Africa's was 4.7%. So you can see the US has had a tremendous surge in inflation relative to South Africa. Certainly, I would argue that inflation is here to stay for some time. And the question on the cards is, will South Africa, on a relative basis, be worse off than other countries such as the US? We've never seen circumstances as we do right now. We've seen some quite anomalous outcomes in the markets. So, for example, typically when the bond market is up, you see the equity market down. We're now seeing both equities and bond market in the doldrums. The effect of inflation in the US is creating a very concerning effect. With Powell having front-loaded those interest rates, going to what is almost unprecedented 75 basis point increases, it's caused what they call an inversion of the bond curve, and that effectively means that short-term money, i.e. 2-year bond yields, are higher than 10-year bond yields, which means short-term money is much more expensive. And as a result of that, in order to counterbalance that, you need wages to be increasing faster than the short-term money yield rate. Stagflation is on the horizon.
And stagflation had been relegated to the appendices of textbooks,
yes.
Where my comment in, I'm teaching the core economics course at the moment, and my comment to the classroom is, this reference to stagflation seemed to be somewhat archaic and relegated to the annals of history. And this was the stuff of the 1970s and 80s.
Yep.
The winter of discontent.
Exactly.
So you think we're back there?
I do think there's a high risk that we are back there. It's very difficult to predict with certainty because there are so many unprecedented events. After the recession, the Great Recession in the 30s, we saw these boom and bust cycles for 10 years after that period. So if I were in the financial sort of investment space, I'd be buckling my seatbelt. And I certainly think particularly the US and even more so Europe are in for a hard landing potentially.
The Bank of America made reference to the performance of the conventional 60-40 portfolio, which has been the default position for many investors over the last 40 years, 60% equities, 40% bonds. Or if you want to be a little bit more edgy, you can make it 70-30. But for the sake of the point, Bank of America estimates that at the mid-year, they think that the conventional 60-40 portfolio, adjusted for inflation, could end the year down 50%. And that's because of bonds and equities, the point you're making earlier, stepping off the cliff together, where that traditional behavior of bonds will act as a diversifier and a defender in decline times. That's just gone missing in action.
Absolutely, and I think all basic economic rules are out of the window right now. It's very, very difficult to make classical predictions. It's very difficult to predict where. I think there are three dynamics affecting where the markets are going. The Chinese lockdown, of course, the Fed's approach to inflation, and then the impact of all of this on supply chain and fuel prices. And so these three elements are going to have a very fundamental effect on the flows in equities and bonds, and particularly between emerging markets and South Africa.
Where do you think US interest rates could go? What's the top side of US interest rates? And what's the top side of the oil price?
Look, it really is very difficult to forecast. What I can probably point to is rather the drivers of that. Okay. I think the dynamics in the US are that they are net exporters of fuel because of their fracking, and that could slightly counterbalance and give them a bit more of a cushioning effect than perhaps Europe. And I think that Europe particularly are vulnerable.
They're far more fragile to the energy imports.
Absolutely, because of their geographic proximity to Russia, their reliance on gas, coal, etc. I think that the Powell did start to raise rates far too late, and whether he's very extreme front-loading of the interest rate is going to have the desired effect is yet to be seen. So I think that it could, the most recent reading was a little bit more positive in terms of inflation. In terms of oil, I think it all depends.
So if I could just pause you there for a moment. The famous Taylor rule, which is used to anticipate what the equilibrium interest rate should be. The Taylor rule says that the equilibrium interest rate in the US at the moment sits somewhere around 7%, which is about 6 higher from where we are at the moment, or 5 higher from where we are at the moment. I think the Taylor rule's forecasting mid-6s. Could it go that high?
Well, I think...
And remember the interest rates of the 80s, where we got into mid-teens and 20s.
I think it all depends on what happens with Russia. I think it depends on the length of the Chinese lockdown and whether we have more lockdowns. It looks like things are easing in China, and it depends on the consumption growth coming out of China, because all of those factors play into the commodity prices, which play into business confidence, which play into the oil price. So I think business confidence, the supply chain unlocking, and the normalization of the oil price are all tightly interconnected.
In this world of much higher oil prices, rising interest rates, rising inflation, supply chain chokes, 4% economic growth becoming 2% inflation becoming 8%. Historically, that is not good news for emerging markets. Historically, that's a place that emerging markets generally find themselves quickly in a bit of a mess. And what's striking is the ways the South African economy and capital markets seem to be navigating this. It's early days. We, 6 months into 2022, and there have been some spectacular disruptions, most obviously the Russian war in Ukraine. But the rand is stable, South African inflation is lower than world inflation, and economic growth is not rosy, but it's resilient.
Ahead of expectations.
Yeah. What's your sense of the domestic circumstance?
Yeah, we're in a really unique position. If you just take a look at the Aussie, which year to date is down 10%, which sounds like quite a negative point. We were up 24. We closed the year up 24%.
But I'll take that versus NASDAQ.
Absolutely, NASDAQ is down 26%. The world index is down 19%. And emerging market indices are down 29%. So South Africa, on a relative basis, is looking really good. We are geographically much more remote from Russia. Our fiscal position, we're the only emerging market country with where our fiscal position is improved prior to during the crisis. And we have a number of structural reform programs that are working quite well. Our bond inflows are 13.5 billion rand positive, although we've lost
over the year
to date.
13 billion rand.
Rand, 13.5 billion rand positive. Now, we've seen a bit of a sort of tale of two quarters for the year to date. The first quarter, we saw South Africa on a relative basis performing really well. And we saw massive inflows into the equity market, which was really pleasing. Over the second quarter, the emerging market environment...
Hang on, why would that be? Because you're talking first quarter, and let's remind ourselves, first quarter is war in Ukraine. This is where we should be running away from emerging markets.
Yes, but the commodity market rallied, and South Africa is diversified miners, PGMs. We produce coal. We produce all the commodities that were in short supply. And on a relative basis, South Africa was also a net winner from, for example, the MSCI Emerging Market Index moving Russia out. But in my discussions with international investors, it was quite extraordinary to hear one emerging market investor said that South Africa is the safe haven of emerging markets. Now, most countries, most of us...
That's quite novel.
Yeah, isn't it?
We
exactly. I mean, their comments are, Turkey with 1,000% inflation is uninvestable. There's deep discontent and concern around China. Brazil are going through an election, so there's uncertainty and the possibility of Lula coming in. And that makes South Africa, on a relative perspective, and especially in comparison to the BRICS, look very positive. For the first time, the investors that we saw were actively, generally speaking, all of them planning a trip down to South Africa.
I mean, that's a fascinating point.
It's a really positive point, and I think we are all just so congenitally negative, and we need to get a more positive and balanced rhetoric out about the country, because on a relative basis, we're performing pretty decently when we compare ourselves to Russia, China, Brazil.
If we bring that positive narrative to South Africa, about South Africa, to the JSE, I mean, you get a bit of a hospital pass. You get given leadership of the JSE in 2019.
Yeah.
This is not fortunate timing.
Indeed. And so when I took over, who would have foreseen that we were about to step into a COVID crisis? And
so what has it meant for the JSE, and what has it meant for you?
At the beginning of the crisis, there was no playbook. Who would have thought that you could run an exchange from the comforts of your home, the entire market? And from a market's perspective, so I think maybe to start, our resilience and our ability to maintain uptime was crucial. Many global exchanges were down. The Australian Stock Exchange was down for almost a day in the November of that year. And many big exchanges were down. And it's quite understandable, particularly in South Africa, where our value and volume of trades were surging, vertical growth trajectories. And And so just keeping the exchange alive was one thing. The second point was obviously making sure that price formation and transparency was available. South Africa is seen as a proxy for emerging markets, which means that when there's a crisis, because we have so many dual-listed large companies listed on our exchange, and many of them extract their revenues from outside of South Africa, there's a lot of shorting that goes on between South Africa and the other markets. And so we saw massive shorting. I was up at 11 o'clock at night speaking to the governor to try and make sure that we had shares that there weren't naked shorts, i.e. shorts, you short a market without borrowing stock to make good on that deal. And we had a lot of that with the international markets. They don't understand our concept of 100% settlement. South Africa is very much of a global player. We are the 19th largest stock exchange by market share, but the 33rd, or actually we're now 36th largest by GDP. So we punch way above our weight. And the volumes and values that we see through our markets really outperform the size of the real economy. And so making sure that we're able to settle and that our stock flow is sort of resilient and stable is a really crucial point, because if we can't settle because one of the internationals has managed to do a deal that they can't make good on the stock, then you create a crisis of confidence, because international investors are, what's going on? Is there a credit crisis? Is it an operational issue? And it creates chaos in an already very chaotic environment. We were also very responsive during the crisis in, for example, very rapidly changing our listings requirements to enable very rapid cash raising of cash, to enable slightly delayed reporting. It was quite difficult for some companies, particularly, for example, retailers who couldn't manage and forecast their stock turns in the current lockdown environment. Who knew how long lockdowns were going to take? And so the evaluation of those on their balance sheet was inaccurate. Auditors couldn't get to the companies to do their proper audits. It was a bit of chaos. And managing through that took an extraordinary amount of fortitude by the team. And look, I'm surrounded by really competent, very smart people. And I always say, I always use that Newton quote. If I can see further, it's through standing on the shoulders of giants, which is very much an academic quote, and that's certainly what happened, not only with the team, but also with the broader community. It was quite extraordinary to see how market participants not only coalesced with the JSE, but also public-private sector engagement was unlocked in a way that we've never seen in the past, and that was quite heartening. And I hope that is going to set the blueprint for collaboration moving forward, and it certainly seems that we're heading in that direction.
The role of the Johannesburg Stock Exchange in facilitating growth and engagement, contributing to economic inclusion, transformation. And inclusion and transformation is multifaceted. It's about a just transition, energy transition, building new industries, promotion of mid and small-sized businesses. A comment was made that the JSE doesn't represent the structure of the South African economy. So we have this disconnect. What's the role of the JSE on this multifaceted arena of transition and transformation?
It's a really crucial point. Firstly, because the JSE must fulfill its social license to operate. And secondly, our contribution on the national agenda is one of our key strategic objectives. And that's because...
So before you go, what's your social license to operate?
Yes, and social license to operate is that we have a social imperative. We have a national responsibility to contribute to the growth of the economy. And that's not just a general social contribution. It's also economically linked, because the exchange is grounded in the economy in which it operates. If we don't have a growing economy, it's very difficult to grow the exchange. We have grown the exchange outside, and there is a separation between the real economy and the JSE. But we've also managed to make some quite real contributions on the national level. So I'll start with our recent announcement to introduce a private placements market. We received a license in December last year, and we officially launched in March. We've got just over 6 billion rands committed by investors, and this private placements market is a bit of a hybrid between the listed entity and a private equity type environment. So we don't have listings requirements as onerous as our IPO environment, but it's not as idiosyncratic and private and opaque as a private equity market. So we have standardized terms and conditions, we've got a platform, we've got standard data rooms that these companies looking to raise capital. And that's really, we've had tremendous success in the few months that we've launched. We've got a long way to go. This is a long line of vision. It's not going to be an enormous economic driver for the JSE. We're not going to make a lot of money out of it, but certainly it's going to create a pipeline. We've had 2 companies issue.
So that commitment of 6 billion is to 2 businesses, or?
No, 6 billion from the investors. So they have, the investors that have signed up have a pocket size of 6 billion.
Okay.
And depending on what issuances come, those are options for them to invest.
And so then the 2 entities?
So we've got 2 entities, and we've got 3 additional entities that are imminent about to issue. And we've got quite a big pipeline, and the sort of genre is, we had a hospital, we've got renewable companies, even mining. What is an area I think that we need to work on is that in Australia and in Canada, the junior miners are really thriving. South Africa doesn't have that level of risk appetite to invest into those exploration companies. And so we are working firstly to improve and encourage inclusion in the retail market, because you need a bigger retail investor base. The retail investor base have a go, speculative and willing to invest in smaller companies. We have largely an institutional market, and the institutions have mandates and they don't want concentration risk, and they're not going to invest as heavily into the small and mid-cap market, which is why our small and mid-cap market has declined. You know, our market cap has gone over the last 20 years from 1.2 trillion to almost 20 trillion. But yet the number of listings has come down, and that number is largely the small and mid-cap markets. So we need to build an environment where small and mid-cap markets can thrive. In addition to our private markets, we also run an accelerator program, and we are in the process of signing up with a government municipal business in the south end of the country. We'll give more details in time to come, to run an incubator of incubators. But in the Accelerator Program, we saw the jobs multiplier by in excess of 20% over the year of that small cohort of businesses. And so this is the growth node of the future. The 2 areas that we're focusing in this private placements area is infrastructure and SMEs. And we think that those 2 are the growth nodes, both of South Africa and into the continent.